So Chinese stocks started 2023 with a really big bang. In the first month of the year, the Hang Seng Index, Hong Kong Hang Seng Index, went up close to 16%. The Shanghai Shenzhen CSI 300 Index that measures the mainland Chinese shares was up close to 11%. Individual stocks like Alibaba, Tencent up 35 to 40%. And all this was fueled by the optimism around the fact that China was now reopening. It was dismantling its zero COVID policy and now refocusing on economic growth once again. The strong gains of the last quarter of 2022 and the first month of 2023 was also because many of the companies were extremely undervalued and oversold, so a strong bounce was way overdue. In fact, foreign investors bought Chinese mainland shares at the fastest pace in 9 years. Over here you can see on the charts that in 2023, January, you can see that the fund inflows were the highest since 2014, which was again 9 years ago. Right? Foreign investors' monthly net buying of China A shares broke through 141 billion yen in January 2023, the biggest monthly inflow since the Connect was launched in 2014. So everything was going great, but then in February, prices stopped going up and prices have been declining consistently for the first 3 weeks of February. In fact, Chinese stocks have given up about half of their gains for January and about 1/3 of their gains since the bottom of the third quarter last year. So what happened? What changed? Did any of the macroeconomic fundamentals change? Not that I'm aware of. In fact, I would say they have strengthened. Have the businesses changed? Have the businesses reported lower profits? Anything wrong with the companies? No. So what changed? The only thing that changed was the geopolitical tensions from this darn balloon. It was a bloody balloon. Well, of course, one could argue that the balloon was an excuse for short-term profit taking, right? So it's not unusual that after a market runs up so fast, it has to retrace. That's pretty normal. It's like my breathing theory, right? You can't go up all the time. After breathe out, you got to breathe in. So right now, the Chinese market is going through kind of like a retracement, kind of like a digestion after very strong gains. And whenever the market goes down, the media will always find something to blame. The media will always find a way to justify why the market's going down. And the perfect thing to blame would, of course, be that geopolitical tensions are again flaring up because of this balloon incident. And this actually happened, again, magically during that time, during the end of January, beginning of February, right? So again, 3rd of February, they suspected this Chinese balloon spying on the US, and of course the US military shoots the balloon down on the 4th of February, and the Chinese are pissed off. Why do you shoot our balloon down? And again, these tensions flare up again. There's a back and forth, and then some foreign funds get nervous. They pull their funds out of the Chinese market, and you get this retracement. So does this kill the bull market for Chinese stocks, or is this just a healthy retracement before the bull market continues? And could this be an opportunity for investors to get into Chinese stocks if they missed out on a very strong run in the last 4 months? That's the first question. The second question would be, the reason stocks have been going down is because of these geopolitical tensions. And is this something that's temporary, or is this something that's permanent? Obviously, if it's permanent, then we should sell all Chinese stocks. But if it's something that's temporary, then again, it could be an opportunity to take advantage of. And the next question would be the underlying economics of the Chinese economy and the fundamentals of the companies. Are they actually getting stronger, or have they been getting weaker? Of course, let's take a look at the technical chart patterns. What do the charts tell us? Do the charts tell us that the uptrend is still intact, or has the uptrend reversed into a downtrend? Let's explore all this in this video. Now, in my opinion, I think that this Chinese spy balloon incident is a very short-term distraction that soon everyone's going to forget about it, and it's not really a big deal. Now, when I first read about this, I was very, very surprised because last year it was very clear that once President Xi Jinping won re-election, he made it very clear that he was going to repair ties with the US and the West, and he was really focused on reopening China, welcoming back investors, and focusing on economic growth. So when I read that, why are the Chinese doing this, sending the spy balloon, I was like, what the fuck, man? What are you doing? Why are you screwing this up? And then when I read this article, it became very clear what happened. Now it seems that this whole Chinese balloon spying incident was not directed by the Chinese political leadership. No, it was not the fault of Winnie the Pooh. It's not his fault. Sorry, Winnie. In fact, it's now reported by the US Pentagon and US intelligence that they believe that Xi Jinping was unaware of this Chinese spy balloon, that this was actually directed by his military, that he was not aware of, and now he's pissed off. In fact, if you read this article, it says that Pentagon official says, I suspect he asked his military about it, like, what are you doing? And his military started to backpedal and give excuses like, oh, well, it says, you make me look like monkey. I will turn you into chop suey. And now he looks really embarrassed because it's like, the left hand doesn't know what the right hand is doing. And there's a major civil-military divide inside the PRC system, and Xi Jinping does not trust his military. So now it seems that, pissed off President Xi, he's gonna probably do something to them, like somebody gonna get hurt real bad, right? So I think it's gonna sort it out. But one thing about the Chinese people is that they want their face. They're not going to admit that, oh, we're sorry, it's our military that went rogue. They're not going to admit that, right? They're going to work it out behind the scenes. He's going to screw his military. He's going to, shoot them. And then they're going to just move on. Of course, in the meantime, they're just going to deny everything and go on the offensive. And, I wouldn't worry too much about this. I think in a couple of weeks, everyone's going to forget about it, and it no longer is going to be an overhang on the markets, and markets going to rebound pretty strongly. In fact, this stupid incident has really distracted a lot of investors from really pretty positive economic news. For example, this was back on 17th of February, just 2 days ago. China now eases overseas listing rules, paving way for rebound. So last year, people were afraid that China was against their companies listing in the US markets, listing overseas. But now China wants to really promote their companies to list in overseas markets, and they are making it a lot easier for new IPOs around the world. So this would really generate more interest in, again, Chinese equities. What else did they do? Well, again, on 17 February, China ramps up its economic support with its biggest ever cash injection into the market. They added a net 632 billion Chinese yen with reverse repos. What they also did was China's Xi Jinping made a speech where he urged stronger measures to boost domestic demand. So basically, they're doing everything they can. They're throwing in the kitchen sink to boost economic recovery, to boost economic growth. And this will be very, very supportive for Chinese stocks. Now let's take a look at technical charts and let's see what it tells us about the existing trend. Are we still on an uptrend, or have we reversed into a downtrend? Now again, remember the lesson? We have got short-term trend, medium-term trend, and the long-term trend. The short-term trend is measured by the 20 and 40 exponential moving average, which is this red and blue thin line. So you can see that the short-term uptrend was signaled over there, where the 20 crossed above the 40. So right now you can see that the 20 is still above the 40. All right, it could cross down, but it's not happened yet. So for now, the short-term trend still remains up. Now, the medium-term trend is measured by the 50 and 150 simple moving average. So as long as the 50 moving average, the blue line, the thick blue line, is above the 150 moving average, then the medium-term trend is still up, up and away, right? And the long-term trend is based on the 200 moving average. So as long as the price is above the 200 moving average and the 200 is sloping upwards, we got a long-term trend. Now, the price has been above the 200, but the 200 is flat over here. And you could argue that it is starting to slightly slope up over here. So in fact, based on the chart patterns, the market is on a short-term, medium-term, and long-term uptrend. So yes, the uptrend is still intact. We are still officially in the Chinese bull market. Again, remember that in a bull market, on an uptrend, prices don't go up in a straight line. They move in wave patterns, right? So you've got, wave up, wave down, wave up, wave down, wave up. And then, of course, starting in early February, we've got this wave down. So we are now in a wave down retracement. So again, the question would be, where's the bottom of this retracement? Is this the bottom of the retracement? Is it going to bounce back from here? Or are we going to retrace lower to here? Or, where's the bottom, right? So let's take a look again at Fibonacci and let's identify potential support levels for this uptrend. So again, now if you take a look at this first wave up pattern. Remember, the wave up pattern is called the A to B pattern. So wave up is A to B, right? That's called the wave up pattern. And B to C is the corrective wave down pattern. And again, C, if it's a shallow retracement, it should be 38.2% retracement. If it's a medium retracement, it's a 50%. And a deeper retracement, which would be a 61.8% retracement. So 38.2, 50%, 61.8%, these are the three magic numbers. So if you take a look at when the rally first started over here off the lows, that was our initial A, right? That's our A to B wave. And so we've got an A to B to C wave. Now this is a valid C wave. Why? Because it retraced to exactly 61.8%. If you use Fibonacci, let me just show you. Click on A, drag to B, boom. There we go. So can you see that 38.2%, 38.2%, that was the exact retracement, all right? So that is known as a shallow retracement. Then the next question is, people would ask, Adam, is this another A to B to C pattern? Is this an ABC pattern? Actually, no, it's not really a valid ABC pattern. Why? Because this pullback did not even reach 38.2%. So because of that, you could argue that this is not really an ABC pattern. Rather, you could argue that this entire thing is an A to B pattern, because this was not enough pullback to 38.2% at least to warrant a B pattern, right? So that's a new A, that's a new B. Now the question is, where's the C, okay? So let's draw a new Fibonacci into this and find out potential C support level, right? So we're gonna click on A, that's our A. Let's go to B. Okay, there we are, right? So again, there are two ways you can identify support levels. One way is to look at Fibonacci. Another way is simply to look at moving averages. So based on Fibonacci, where's our 38.2% support level? It is right here. So let me draw a line to kind of like identify that. Somewhere over here. That could be a support level. Second support would be the 50% retracement, which would be pretty near the 200 moving average. All right, so that could be a potentially second support. And a third potential support would be the 61.8% level, which would be here. There we go. And let me just get rid of this color so that it's a bit clear over here, right? So that could be a support level, that could be a support, that could be a support. Now again, in technical analysis, we can't predict exactly where the bottom will be. We can only anticipate potential support levels based on Fibonacci numbers, right? At the same time, you can also look at moving averages to identify potential support levels. So you can see that the 50 moving average is obviously a very strong level of support, which right now you can see that it has retraced right to its 50-day simple moving average, which is very much near that first 38.2% retracement level. So in other words, this area here, we are very close to a potential bottom if it's a shallow retracement in the grand scheme of things, right? But if it breaks below this level, then my next level of support would be this over here, the 50% retracement that coincides with the 200 moving average. And if it breaks that level, then I will say the last level of support would be the 61.8% retracement that coincides with this green line, the 150-day simple moving average. So these are three support levels I'm watching very closely. So again, how do you make use of these support levels as a trader or as an investor? So again, if you are trading the Hong Kong markets, for example, then you want to wait for a confirmation signal For example, wait for a bullish candlestick pattern, like a bullish engulfing pattern or a double bottom pattern or a bullish pin bar pattern. And you can look at certain indicators like check that relative strength is oversold, MACD has turned bullish, you can do all that stuff as well, all right? Or Bollinger Bands are oversold. So we're waiting for some kind of confirmation with a candlestick pattern before going long. And we take a long trade to catch the wave up, all right? If we don't get a pattern and we wait for the pattern over here, wait for the pattern over there. So we're waiting for a confirmation pattern to enter as a trade. Again, it's a trade. Remember that there's no 100% it's going to go up. So always have your stop losses in place, have your profit targets in place, and always risk a small percentage of your capital. However, if you're entering it as an investment, there's no stop loss for an investment, but you take a longer term view because in the long run, the index always goes up over time. Great companies always go up over time. So you dollar cost average in your position. So for example, if you intend to invest, say, $10,000 into the Hong Kong markets via ETFs, then you don't buy $10,000 worth all at once, right? You break it into 3 or 4 tranches. For example, 3 tranches. You invest, $3,300 at the first support level, and if it retraces to a medium-term support, you add another 3,003. If it retraces to the last support level, then you add your last tranche, and you dollar cost average in your positions because eventually it's going to reverse and go higher as long as the fundamentals support that. So do I think that the economic fundamentals and the corporate earnings support much higher equity prices for Chinese stocks? Yes, I do. In fact, you can see from this chart that Chinese corporate earnings have rebounded pretty much from their lows during the recession and during the pandemic lows, right? So Chinese corporate earnings have been growing way above the GDP of the country, but the stock market, stock prices have not yet reflected the earnings of the companies. And you can see the Hang Seng Index that measures the market cap of the largest Chinese companies on the Hong Kong stock market has a huge divergence, right? There's a big divergence between the actual corporate earnings and the market price. So this eventually will rebound and catch up to corporate earnings. So there's a lot of upside for the market. And that is why if you take a look, currently the price to earnings ratio of the Hong Kong market is at 9.6 times earnings, which is below the 20-year average and half that of the US, right? US PE ratio is over 20 times earnings. China is like 9 times earnings. If you take a look at the US, for example, you can see in the long run, US corporate earnings, again, they are way above US GDP, but in the US, the markets are more efficiently priced. You can see that the S&P 500 or the stock market moves pretty much in line with corporate earnings. When corporate earnings go up, the S&P goes up. Sometimes S&P will lag corporate earnings, but sometimes the S&P will catch up to corporate earnings, right? They kind of like move very close together. But for the Chinese markets, you can see that there's still a big divergence between the corporate earnings, the profits earned by companies, and the actual stock market. In other words, Chinese stocks are relatively much cheaper than US stocks. Chinese stocks do not accurately reflect the true value of Chinese companies. Eventually they will. It will take time. It's not going to happen overnight. So why is this big divergence? Now, there are 2 reasons. The first reason is you got to understand that the Chinese stock market is still very young. The modern Chinese stock market is over 30 years old. That's it. Whereas the US stock market, the modern US market, is over 160 years old. So because of that, in the US, over 50% of US households own US stocks. So a lot of Americans are invested in the stock market. They put their money into the stock market. Whereas in China, only 7% of Chinese households invest in the stock market. But that is growing in an exponential way. So as more and more Chinese people start to learn to put their money in the stock market, that would increase the liquidity of Chinese stocks and then eventually raise it to catch up with the true value of the company. Now, that's not going to happen overnight. It's going to take time for the Chinese market to mature. Another reason is, for example, if you look at the Hong Kong market, roughly about half of the buyers of Hong Kong stocks are locals, right? Local Chinese and Hong Kong people. But the other half of the buyers are foreign investors. So whenever there are political tensions or political issues, foreign investors pull out their funds and the market gets very volatile. It goes down like what you saw this month. But once confidence comes back, once the political issues are resolved and the foreign funds start to flow in, then you see huge rebounds in the Chinese market. So the Chinese market is one where you got to take a longer term view and you got to be able to stomach the short-term volatility. If you're not able to do that, then don't invest in China, just invest in the US. If you're not willing to take a long-term view, then of course this is not something for you. Now, having said that, as you guys know, I invest in the China markets, but I don't have a big exposure. Chinese stocks only represent 10% of my portfolio. 90% of my portfolio are still in US markets, all right? Because Chinese markets tend to be a bit more volatile, a bit more uncertain, but the upside can be phenomenal. Once, like I said, the market price catches up to the corporate earnings and valuation. So there's a huge upside potential. So I'm taking a small stake in the Chinese markets for those reasons. In fact, Chinese stocks are so cheap right now and offer so much value that even Mr. Perma Bear, Michael Burry, who's known to be such a bearish person who always says sell, sell, sell. I mean, this guy was buying Chinese stocks in the fourth quarter of last year, which was pretty surprising to me. So you can see that Michael Burry in the fourth quarter of 2022, he bought about $4 million worth of Alibaba, $4 million worth of JD.com into his portfolio. Now, does what other investors do affect my decisions? Not at all. I don't care what the hell Buffett or Burry are buying or selling. I don't give a damn. Doesn't affect my investment decisions. It could be selling, I could be buying, vice versa. But it's interesting to note that again, this guy who's so damn bearish all the time is actually bullish on China. So he sees that tremendous value that stocks offer right now. So taking a look at some individual names, first of all, Alibaba, BABA, you can see it still remains on an uptrend even with the recent retracement. You can see if you use again your Fibonacci tool, you can see wave up to wave down. This is exactly a 38.2% retracement. Another wave up to wave down, another 38.2 retracement, and then wave up and wave down. So you can see this was the 38.2% retracement. It broke past that 50% retracement at the 50 moving average. It kind of like broke past that on Friday. But the next support over here is the 61.8% retracement level. So it is still on an uptrend and it's still above the 61.8% retracement level. But I am not surprised that it may even break and find support at the 200 moving average. So this could also be a significant support because this was a previous area of resistance, and it could be a very strong level of support at $92. Now, again, it may or may not reach $92 because it could also bounce off this 61.8% retracement level. So I guess a lot depends on earnings. So many of the companies, Alibaba and Tencent, they're going to announce earnings really soon. Alibaba will announce earnings on, on the 23rd of February. So I remain bullish on Alibaba for the fact that it is still very undervalued. Now, don't be mistaken by looking at the current PE ratio. Some people will look at the PE ratio. My God, the PE ratio is so high at 259 times earning. Are you nuts? No, be careful because PE ratio can be misleading if the current earnings have been distorted or skewed because of short-term increase in earnings, R&D expenses, or short-term mark-to-market losses because of marketable securities. And that's what happened to Alibaba. So you're going to look at what we call the forward PE based on its projected earnings, taking out the non-recurring items. So the forward PE is about 11 times earnings. And the enterprise value to EBIT is 17 times earnings. So it's relatively still very, very cheap. Now, some of you may realize that Charlie Munger, who holds a lot of Alibaba, did mention recently that it is one of his biggest mistakes buying Alibaba. And some people freaked out when he said that. But if you read into what he said, his mistake was not the fact that Alibaba is a Chinese company and he don't believe in it, but his mistake was he thought that Alibaba was a pure internet company. Duh, it's not, right? And now he says, oh, now I realize it's a retail business, and retail business is a lot more competitive than a pure internet business. So that was the mistake he made. So you can see that even these great investors, sometimes they don't do proper research. So yeah, Alibaba is by heart a retail business. So they do have competition against Pinduoduo, JD.com, but they also have their cloud business as well. And of course, the retail business is a bit more competitive than a lot of these pure internet cloud businesses. And that's why Charlie Munger, if you read recently, he has actually been building a stake into Tencent. Although it's not officially disclosed, but many people through their research have found that the undeclared stock that he holds is actually Tencent. And I do agree that between the two, I actually prefer Tencent because Tencent has a lot more margin expansion compared to Alibaba. But they both are pretty cheap as well, right? So you can see Tencent over here, the PE 17 times, forward PE 22 times, and given their potential rebound in growth, I think it's still a pretty good deal. And the Chinese government's recent push to boost local consumption demand, that would be a big plus for companies like Alibaba and Tencent. So still bullish on these two companies over the long run. Again, I'm not saying that it's going to go up tomorrow or go up next week. You never know. During a retracement, it could still retrace a bit more. But over time, we should see a rebound in these companies, right? So again, Alibaba watching this 61.8% level. And if it breaks below that, we still have this strong 200-day moving average on Alibaba. Finally, if you look at Tencent, you can see Tencent's retracement has been a lot more shallow. You can see this wave up, wave down, wave up, wave down, and this strong wave up, right? And this recent retracement to its 20 exponential moving average. So don't be surprised that it could also retrace down to the 50 moving average as well. Now, if you put in a Fibonacci, you can see that it could still retrace a bit more. Let's take this as the A, B, C. Right, so you can see that, for Tencent, the 38.2% retracement is there, which is near the 50 moving average. So again, don't be surprised that it retraces a bit more down to this 50 moving average and the 38.2% at least before it continues its uptrend. So for people who kind of were too slow to catch this really strong wave up, here's a second chance for you to get in after this retracement. So like I keep telling people, never chase a stock, never have FOMO and chase a stock once it runs. It's like never chase the girl once she runs away. Always wait for her to run into your arms, okay? Buy on retracements, buy on support levels, and that's how you get in at a better price. So earnings are also coming up pretty soon, next week. So if you're trading, I would wait for earnings to be released first before taking a trade. But if you're investing for the long run, then it doesn't matter. You could take, build a position and dollar cost average in even before earnings if it hits those support levels. So hope you enjoyed this review on the Chinese markets, and I'll see you guys in the next video. If you want to catch my latest videos, click on the subscribe button right now. Click on the bell so you get instant notifications once I upload my latest video. If you want to check out my online courses, go to piranhaprofits.com. We're going to learn how to invest and how to trade the financial markets and create an income from all around the world. If you want to join my live Wealth Academy program, go on to wealthacademyglobal.com and find out more about how you can learn investing and trading live online. This is Adam Khoo, and may the markets be with you.